Good morning, everybody. Thanks for joining us today. We're looking forward to a good discussion. I'm John Griswold, Chair of the Board of Greenwich Roundtable, and substituting today for Steve McMenamin, who's away. I'd like to welcome our panelists and to first introduce Jim Gasparoni, who is going to moderate this panel and introduce the panelists. Jim is a partner and oversees Flag Capital Management's Global Real Assets Program. Prior to joining Flag in 2006, Jim was Managing Director of Real Assets Investments for Brown University, where he was responsible for all real estate, energy, timber, and commodities investments. Prior to Brown, Jim was part of the Real Assets Investment team both at Princeton University Investment Company and at Nassau Capital, a private firm investing on behalf of Princeton. He also worked for Corporate Realty Investment Company and began his real estate career at his family consulting firm, Gasparoni & Company. Jim holds an MBA from the University of Massachusetts, Lowell, an MS in real estate from MIT, and a BS from Boston College. He's also a CFA charter holder. So please welcome Jim, and Jim, take it from here.
Great. Thank you, John. Well, good morning, everybody. When Steve approached us to talk about real assets, you couldn't have picked a more timely topic, and the reason for that is we, on the Flag Real Assets team, travel around the country and, in fact, the globe. There's no more topic of interest among investors than real assets for a variety of reasons, not the least of which is there are a number of institutions today that are seeking to build meaningful allocations in this space, and they're looking for solutions and looking for managers to execute on a strategy. You know, historically, the two primary reasons from a portfolio perspective to have real assets in your portfolio are inflation hedging, because if you look historically, real assets investments historically have been positively correlated with the changes in the rate of inflation. And also diversification. Also those historic track records of real assets investments show independent return patterns when you consider financial assets. Obviously, in the last 5 years since the global financial crisis, there's been increasing concerns about illiquidity, wondering if you're getting paid for the risk. And as a point of fact, you can build a prudently diversified real assets portfolio in the public markets or through more liquid investments, whether it's commodities, whether it's public energy stocks, whether it's MLPs, or in your inflation hedging fixed income portfolio through TIPS. So the question we always ask or get asked is, what is the rationale today for investing in real assets through private investments? Are you getting paid for the risk? What are the opportunities? And so that's a question that we hope that the three panelists here can help us answer. I'm joined today by three people who focus on very specific opportunities in the natural resources continuum. We have Ben Dell from Kimmeridge Energy, here right to my left. Next to him is Chris Jones from Haddington Ventures. And then finally, at the far end, we have Gary Cernovus from Lime Rock. And we're going to ask each one of them to talk for about 15 minutes about some of the things that they pursue. And hopefully at the end, we'll be able to answer that question. And then we'll open up for questions and answers. So without further ado, I'd like to introduce Ben Dell.
Great. Thank you, Jim. After hearing your bio, I feel somewhat underqualified to be here, but thank you. I thought before I start about what Kimmeridge does and the strategy we sort of focus on, I thought it'd be useful just to look at the specifics of the upstream oil and gas investing arena, and also worth touching on how historically investors have made money in the sector. I think what's interesting to me, when you go back in time, whether it be public or private in the energy space, what you've seen pervasive through the sector is a number of major thematics that have altered the oil and gas landscape. I always make the joke, if you ever watched There Will Be Blood, you know, the guy is walking out in West Texas looking for oil seeps on the ground, and that was the origination of the industry. Since then, we've gone from, drilling with 500-foot holes to 14,000-foot holes. We've gone from onshore to offshore exploration. We've drilled pre-salt to post-salt, vertical to horizontal. In the enhanced oil recovery world, we've had water flood, gas flood, miscible fluid flood, CO2 flood. And we've gone from 2D to 3D to 4D seismic. And more importantly, in the last 10 years, we've seen an emergence of what people would consider unconventional resources versus the exploration of conventional resources. When we look at the space in general in energy and we think about how to invest in it, what's notable about these themes to us is that you can really bucket them into three, which is geology, technology, and commodities. We've either seen structural changes driven by new technology, for example, 2D, 3D, 4D seismic, or the movement into the deep water. The emergence of new geology, whether it be West Africa, Brazil, or unconventional resources like the Utica or Marcellus in Pennsylvania. And then what you've dealt with as an energy investor is that these big thematic structural changes have been framed within a commodity price environment where geology and technologies changed the marginal cost of supply. So from 1970 to 84, you had a rising marginal cost of supply, 84 to 98 declining, and then 98 today rising again. And then on top of that, you've put cyclical trends driven by GDP demand cycles, which have seen you move plus or minus 50% in the commodity price environment. I think for private investors, or at least what's most notable for me, is that when you look at these trends, they've tended to be 5 to 10 year events, and that really the way to exploit them is to have the patience, the duration, and the perseverance to stay with them over the long term. If you focus more on the upstream business, and particularly my sector of exploration and production, what's interesting to me is the industry right now is in the midst of one of those major thematic shifts with the evolution of unconventional resources. Most notably, the exploitation of these low porosity, low permeability reservoirs through the application of new technology, particularly horizontal drilling and multi-stage fracking, coupled with a higher price environment, has allowed a number of what was previously considered uneconomic reservoirs and rocks to be opened up for new production. When you look at how disrupted that's been in the gas market, you had from really 2003 to 2008 a huge explosion in U.S. onshore unconventional production, which has continued. But since 2008, that overflow of production has led to a collapse in U.S. gas prices. But it's also driven more specific things such as growth in Northeast production and a reduction in Rocky Mountain production. It's changed the U.S. power and utility market. And I believe the U.S. gas supply, actually right now, the next big thematic, has the potential to change the global U.S. LNG market. In the oil market, we're seeing a similar dynamic. We've seen the resurgence of a number of mature basins. We've seen the Bakken come out of North Dakota. We've seen the Eagle Ford. We're now in the process of watching the Permian emerge. We've seen the positives of that, big ramp-ups in activities. We've seen the negatives, huge oversupply of NGLs or natural gas liquids, which has been good for the chemical companies but bad for producers. And we've also seen the reemergence of historical production centers, as I said, places like Ohio, the Appalachians, North Dakota, and from my perspective, we believe the next one on that list will be Illinois. But as you've seen in the public markets, these big shifts have not been easy to take advantage with. What's remarkable to me right now is that we have one of the highest level of CEO searches in the energy space. And that's because there's a number of public companies that have missed the boat. There's a bunch of public companies that have got the boat. And to give you an idea on the public space, you've seen people like Laredo, et cetera, up 100, 150%. You've seen people like Encana, who have not seen their stock move for over 4 years now. But that winning in this space has been about identifying oil and gas resources that are structurally advantaged on the cost curve, so in that top quartile of performance. And when you look at the history of what that's been driven by, it's by being a first mover, being in the core of these areas, and understanding the structural backdrop that you're working within from a broader commodity environment. So what do we try and do at Kimmeridge, and how do we try and exploit this? From 2003 to 2010, I should caveat this. I'm a geologist by origin, so I have a tendency to talk about geology and people look blankly at me. So I'll apologize in advance. But from 2003 to 2010, I was a sell-side analyst along with another colleague of mine at Kimmeridge, Neil McMahon, who's also a geologist. And we spent a large amount of our time in the sell-side world looking at where are the advantaged oil and gas assets in the world, whether it be West Africa, in Angola, Brazil, onshore North America. We wanted to identify those operators who are moving down to the front end of the cost curve and identifying cost-advantaged barrels of production. What was interesting to us is that in 2005, the unconventional boom started in North America. And one of the things that you heard from a lot of operators was that unconventional resources were like manufacturing plays. Everything looks the same. You're just punching holes in the ground. Every well performs the same. But when we looked at these plays from a geology standpoint, what we saw is that they were like Venn diagrams. You had 7 or 8 overlapping factors depth, thickness, porosity, permeability, mineralogy, total organic carbon, vitrinite reflectance, or maturity that overlapped. And where they all overlapped perfectly, you had that core of the Venn diagram where everything worked well and you had the best well performance. And as you went away from that point, the play gradationally got worse. And to give you an idea, if any of you know the Barnett Shale, the difference in well performance between the core and the fringe is 10-1. So while everyone can say they're in the Barnett Shale, the real question is who's in the core of the Barnett Shale. And we used to talk about these things in terms of core, tier 1, and tier 2. But what was interesting to us was whether it was an operating company or whether it was public investors, most people didn't understand the heterogeneity of these reservoirs, because to do that, you really had to understand geology. You had two methods. You could either wait for the well results to be announced and then map out where were the best ones and the worst ones, or you could in advance work out what actually drove the well results, map that out, and make your investment premise based on that. And after about 3 to 4 years of writing about this, in the end we decided that we should put our money where our mouth is, and in 2012 formed Kimmeridge. And as I said, at a high level, the goal of Kimmeridge was to create an alternative asset manager focused exclusively on the energy sector, where we could leverage our unique experience both as geologists and operators to make better investment decisions. Specifically, though, what we focused on was early-stage unconventional exploration and putting together our own geology team, both now in Houston, Denver, and Illinois, to go and look for new and emerging unconventional resources plays, or the next generation of those. In addition to the focus on exploration, which I think is unique about what we do, the other thing that we decided to do was actually to own the asset directly. So I always say we look a lot like a private oil and gas company, and that we don't back management teams. So I was telling Jim and showing him some pictures earlier, a lot of my time spent sitting in sheds waiting for farmers to come off, equipment. In fact, you probably know most of the farmers I'm dealing with. And negotiating leases, one by one in these areas and building out our presence. In essence, what we try and do in our funds is really focus on two skills. And one of that is to identify new and emerging geology early, so to leverage our geology base. And the second is to go and take land aggregation risk and to be able to aggregate land positions quickly and cost effectively. But I think the easiest way to explain this, and I think Jim mentioned this, is probably to give an example of exactly what we do. Before I do that, one of the analogies I also give investors when thinking about the unconventional resource space and oil and gas exploration is the relationship between clouds, rain, and puddles. And the reason why is if you think about a source rock for oil, it's like a cloud. It's a rock, it's saturated with oil, and as it gets buried, the oil gets released, and the oil forms in traps. And it's much like the inverse of a cloud. A cloud becomes saturated, it rains, and the water forms in puddles. And if you think about conventional exploration, it's like taking a straw, walking down the street, and putting a straw in a puddle. If you suck on the straw, you get a good flow rate. I wouldn't recommend it, but if you do it. But the thing is, you only tend to hit a puddle about 1 in 10 times, or maybe 1 in 3 if you're lucky. But you get a good flow rate down that straw. In the unconventional space, what you're doing is looking at the cloud and saying, well, I know the cloud's saturated, and I'm going to put my straw in the cloud. The problem with putting a straw in a cloud is you don't get a good flow rate, so what you have to do is redesign the straw to make it longer, a horizontal well, for example, and then frack it to increase the surface area to allow you to get economic flow rate down the well. The reason I give this analogy is twofold. First, much like clouds and rain, the best clouds you're ever going to find is in a place where you've had a lot of rain or a lot of puddles. And that's a fundamental belief of ours that there's a structural relationship between conventional production in a basin and what the unconventional resource potential is. The second reason I give the analogy is clouds aren't uniform. There's good parts, bad parts of the cloud, and it's about focusing on where you have the richest part and the highest degree of liquid saturation. That's essentially what brought us to Illinois first time around. While not largely appreciated, Illinois in the 1940s was one of the big 5 oil-producing states in the United States, along with Texas, Louisiana, Oklahoma, Kansas, and Pennsylvania. In fact, in 1940, Illinois produced more barrels than Oklahoma on an annual basis, or 400,000 barrels a day. To put that in perspective for you, any of you who follow the Bakken, that's equivalent to North Dakota's production in 2011 coming out of the Bakken. And since 1900, Illinois has actually produced nearly 4 billion barrels of oil, but it peaked, as I said, in around 1940. The source rock for this oil is the New Albany Shale, and it's actually one of the richest source rocks in North America, and by USGS estimates has generated 140 billion barrels of oil, a number which we incidentally think is light based on drilling we've now completed and geochemistry analysis that we've undertaken. So put into the analog, Illinois has a lot of puddles and it's a very, very big cloud. While Illinois looked attractive from a geology standpoint, when we first got into Illinois, it was pretty obvious why no one else had been there. First, the New Albany Shale, as you go into Indiana, becomes shallow and had been tested as a biogenic gas play unsuccessfully. So from a name standpoint, people associated New Albany with a biogenic gas play that had failed. But the second, and by far and away the much bigger issue, is that leasing in Illinois is miserable. What you have is both land packages tend to be separated amongst multiple families. Surface ownership and mineral rights are separated. And to give you an idea of a scale of how difficult it is, we were a first mover in Illinois building our position. Our average lease package is 40 acres. To put that in context, in the Permian right now we're leasing, and we would argue the Permian's a competitive area, our average lease package is 4,000 acres. Now, when you consider you need a 640-acre parcel to drill a horizontal well, it means you've got to put a lot of pieces of the puzzle together. And that requires both time, patience, perseverance, and significant landman cost. But ultimately, that's what we look for, which is to take that land aggregation risk. As I said, while some people would condemn the play based on that, and it certainly is a material risk, because with 5,000 or 10,000 acres, it's hard to sell that position. We believe there was a lot of value in it, because if you do hoover up the large positions and you put this together, you drive up the replacement cost of the asset. So we went into the basin, and over the first 24 months, we leased around 50,000 net acres in what we believe is the core of the play. To put it in context, nobody had drilled horizontal wells in the New Albany. Nobody had drilled vertical wells. In Illinois, there's no production history per well. The state records aren't kept. And the last annual report produced by Illinois on the history of the industry was 2009. So data is hard to find in the basin, and the only way to go and get data is to ultimately take it yourself. On average, we paid $250 an acre to the landowner. We paid about $200 an acre for landman cost. That's running title. As I said, one of the most expensive areas you can work in. We started leasing at $25 an acre, but we were soon joined by Plains, which is now McMoran, Rex, SM Energy, Woolsey Citation, a number of competitors came into the area. And today, prices to landmen are about $450 an acre. Once we build our position, one of the things we try and do immediately is mitigate risk, and we took a third of our asset to the market, and we sold a third of our asset for $750 an acre, and the buyer also agreed to drill 2 wells, which would be carried through. So the net cost within about 12 months was about $825 an acre that we monetized that asset for. And this is ultimately the perfect example of land value creation in land aggregation. While the person who was buying the asset could arguably have gone out and put together 17,000 acres themselves, the reality is we had a ready-made position, we were in the core, we had taken out most of the large landowners, and it would have taken them 18 to 24 months to put a similar position together. The second element of the Kimmeridge strategy that I talked about is taking on geological risk. And as I said, when we first got involved in Illinois, there was limited production data in the area and limited geological data. We had put together a model of why we thought it was attractive, depth maps, isopac maps, a lot of geochem run on 1970s and 80s data. And we thought the oil in place was large. But ultimately, the next stage in the asset is geological de-risking, and that's something we've now begun to do. As Jim and Ryan are aware, we've now drilled 6 wells in Illinois, 6 vertical test wells. 4 of those are now going on production. We actually just this morning TD'd another well that'll go on production in the next couple of days. And the key next part of the strategy is to de-risk that geology, collect the data through the vertical wells, and prove that what you think is a large oil and gas in place can actually be producible. And that ultimately is the second part, which is when we enter a basin, we sort of say, there's how much oil and gas do you have in place, how recoverable is it, and then what are the economics of doing that. Before we get in, we might know there's a lot of oil and gas in place, but until we drill a modern vertical well with core data and analyze that, until we drill a horizontal well, we don't know that it's recoverable, or at least recoverable at an economic cost. So we've been in Illinois now for about 24 months. We've drilled 6 wells. We've taken over 1,500 foot of core, which is actually more core in the last 12 months than Illinois has seen in the last 13 years. And as I said, we put a number of these wells on production. While we've yet to monetize our position, I would say we know that we can market our asset pre-drilling any of these vertical wells at over $800 an acre. We now have effective production coming out of the ground, so we know we have economic wells that are being drilled vertically. We've also seen competitors, as I said, Rex and Mary, start to drill offsetting wells. Rex drilled the first horizontal with a very high initial production rate, which also looks economic. In our second fund, we've continued building our lease position in Illinois. We now control nearly 80,000 gross acres, and we think Illinois is going to become one of the big emerging unconventional plays of 2014, driven in part by our activity, but also competitors, and will continue to grow. To put this in context, this is not a one-off. Between our 2 funds, we have 6 unconventional plays. We own over 600,000 net acres. We drilled 7 wells this year and have nearly 30 wells planned for next year, a combination of verticals and horizontals. And I said the core of what we try and do is to really go back and focus on that first part, which is identifying new unconventional opportunities where we can take land aggregation risk, geological risk, de-risk those, and then exit them to, generally speaking, people with a lower cost of capital to take them through the development market and deliver to our investors the 30% type IRRs, 3x type returns in the private space.
Well, thanks, Ben. You know, one of the themes I think you're hearing is that there's opportunities in emerging or semi-established plays today in the United States, and one of the issues with some of these emerging plays is the lack of infrastructure. I think another theme that we hear when we go out and talk to investors is interest in how this new commodity and these new emerging plays are being stored or transported. And so there have emerged over the last decade or two experts in this field on a private capital basis, one of which is Haddington Ventures. So I'd like to ask Chris Jones to talk about his experience and some of the things that he's saying.
Jim, thanks very much. I appreciate the opportunity to visit with you folks today. Thanks to Flag and Greenwich for Roundtable for having us up here. Haddington, tell you a little bit about who we are and what we do, where we came from, and where we see the opportunities on a going forward basis. We're a midstream energy infrastructure fund. We're focused on grassroots or greenfield or brownfield development. We will opportunistically make acquisitions in our fund. However, given the interest rate environment and the dominance of the publicly traded master limited partnerships, we found very little in the way of acquisition opportunities over the last several years, certainly since 2010. We're currently investing our fourth fund, which was a $350 million fund approximately that we closed in September of 2012. We originally got in this business in 1998 when our first fund we raised was a $77 million fund. Prior to founding Haddington, my partner and co-founder, both TPC and Haddington, were involved with a company called TPC Corporation, which was also a midstream-focused C corporation that at the end started with $1 million of venture capital from a couple of family offices in Houston and built it up over a 13-year period and sold it to Pacificorp in 1997. We felt at the time we sold TPC that the type of things that we were doing in a public company were generally not well received. We were doing a lot of grassroots development. There was 2 or 3 years of deep J-curve investing before the returns really showed up. And it was not conducive to meeting quarter-to-quarter earnings growth. So after the sale, we decided to go in the private equity business, and that's why how we're here today. There were 4 senior partners in the firm, 4 junior partners, and a senior analyst. Most all of us bring a operating company background. We've got a lot of engineers, CEOs, CFOs, COOs, VP engineering and construction. We've sort of been there and done that before in our predecessor company, which we think gives us a leg up in the type of investment that we're doing here with the Haddington funds. Okay, so what are we talking about when we talk about midstream infrastructure? We generally, in Haddington, do not take the type of risk that he's taking. After the hydrocarbon is found and it's at the wellhead, it generally is not ready for consumption at the burner tip or in your gasoline tank. So we build gathering systems, we build processing plants, we build storage facilities, we build pipelines. We basically get to the commodity all the way up to a city gate or to a downstream refinery, anything in between. As you move further towards that consumption point, you tend to run into more regulation, particularly on the natural gas side, as you move into local distribution companies. So we would not go that far downstream. If you think about the issues that the industry faces broadly, energy industry today, is the fact that the producers, drill a well and they want to produce it 24 hours a day, 365 days a year. The consumption of those commodities tends to be much more cyclical, whether it's seasonal or it's economically driven. So you need to build clutches in the system, if you will, that helps balance supply and demand. In the natural gas industry today, we've got way too much supply and not enough demand. That's going to change over the next several years. Conversely, on the crude oil side, you have an entirely changing dynamic here in North America, in the United States in particular, where we're backing out all the importation of foreign oils and replacing it with domestic production, or certainly Canadian production as well. So the question, I think, before y'all today, as you think about infrastructure, as you think about midstream infrastructure, the argument that we would put before you is that the returns that are generated from this infrastructure, we're not targeting 30+%. We're kind of in the high teens, low 20s net returns, which we're attempting to deliver to you. We don't have as much commodity price risk in our portfolio as an upstream company. Most of the fees, most of the revenue that we collect at the portfolio company level comes from fees for services. So we get so many cents per MCF, so many cents per gallon, so many dollars per barrel, so much for storage, so much for transportation. We tend to be less affected by direct commodity prices and the volatility associated with that. One of the ways we go about mitigating the risks of development, we're often asked, well, it seems like you have it's almost like a venture type portfolio. You have a lot of binary outcome risk. Your deal works or it doesn't work. And if the way we have risked the capital over the years to do this development, to gather all the entitlements that are necessary to build a storage facility or a pipeline, we think ultimately leads to very low risk on the development side and very high potential returns for our investors as we move from development into construction, ultimately operation, and then sale to somebody who's interested in a cash stream that's relatively consistent with attractive growth rates, where they have a much lower cost of capital than we do. And here we're typically thinking about the publicly traded master limited partnerships, who again have dominated that space. So the last bit of, if you will, value that we add at this point, that we've been in this business now for 15 years, is the ability to be able to recycle management teams. We have third and fourth generation now investments from people that work for us at TPC. We did investments with them in our earlier funds, 1, 2, and 3, and are now backing them again in Fund 4. If we look at the shale, the energy revolution that's going on in this country, the renaissance, we think about it in less elegant terms, and we call it the replumbing of the energy infrastructure of the United States. Historically, hydrocarbons were found, if you go back to the early portions of the 20th century, generally along the Gulf Coast and in the Mid-Continent and Rockies area, and they were then distributed to big consumption centers, whether it's in the Northeast, Midwest, West Coast. So all the infrastructure is designed to take flows generally from the southern part of the country to the northern part of the country. With the development of the Utica shales and Marcellus shales and so on and so forth, that's all changed. gas wants to now come from the north to the south to get to the consumption centers, refineries, petrochemical plants, and things of that nature, as well as to continue to get to the coast. So that then creates opportunities for infrastructure funds. Once upstream guys found it, we have to help them figure out how we're going to get it to market and get it to a point where it can be consumed or to be exported out of the country in the form of LNG or refined products. If you think about where the industry sits and where the thinking in this country sits, I think that we need to contemplate changing the biases that were built over the last quarter of the 20th century, where we were in a period of shortages, higher and growing costs of hydrocarbon, to an era that probably lasts throughout the balance of this century with respect to very attractively priced hydrocarbons that will go into investments, refineries, petrochemical plants, export facilities that will generate jobs, generate taxes, improved environmental emissions situation here in the U.S. I don't know if y'all realize this, but in 2012, the United States passed Russia as the larger producer in the world on a barrel of oil equivalent basis, in excess of Saudi Arabia as well. At the same time, and if you look at the emissions profiles of the United States in a non-Kyoto Treaty country, we hit emissions that were equivalent to 1993 levels. Our emissions are actually going down. Europe's emissions are actually going up because of the craziness that they've set up in their carbon market. So I think there's economic benefits, there's environmental benefits if we adopt and support the continued development of these resources. Okay, so I've tried to paint a rosy picture. What are the risks that we see associated with this change in evolution? There are still environmental risks. Is the U.S., what are the new rules and regulations that are going to come out of the Environmental Protection Agency? We have seen to date the effect has been to back coal out of the system and replace it by natural gas, which has had a tremendous environmental benefit, as we've discussed. There are discussions underway in D.C. about carbon taxes. If there are carbon taxes, what is the price level that they're going to be set at? How long is the industry going to have to adopt to those? And where do we? How is that going to affect people thinking about committing capital to the space? If you look, though, again at Europe, Europe is, because they have a poorly designed carbon tax market, you're actually shutting down brand new, recently completed combined cycle cogeneration plants, replacing it with coal-fired lignite. They basically burn dirt to make electricity with worse emission profiles. Because their carbon tax is set so low, you end up seeing carbon at $1 a ton versus, say, California's system that they're trying to implement that's something on the order of $15 a ton. It is like Europe, it's like Alice in Wonderland over there. If you look at what we're doing in the United States and you look at what's going on in Europe, I think we've got a better model, but we'll have to see how that all develops. If you think about another risk that we're concerned about is this dislocation that we see in pricing. These very low prices for natural gas have now stimulated, I think DOE has granted maybe 6 permits or something like that so far for export to non-free trade agreement countries. Each one is, 2 to 4 BCF a day. There's a tremendous amount of demand coming. There are political risks associated with that. The Dow Chemicals of the world, the Senator Markey now, I guess, in Massachusetts, they would like to keep those hydrocarbons here in North America, which would be fine with us so long as Dow agrees not to export any of the cheap plastic that they make. right? We'll see how that all develops, but there are some political risks associated with decisions that Congress may make about import and export of commodities. Our view is, if you look at what's going on in Canada, the U.S., and Mexico, we could get to the point where we're going to be come very close to being completely energy dependent, which has all sorts of, I think, positive ramifications for the geopolitical risks that we face in the Middle East. I think it's very difficult for people to argue that we shouldn't be allowing exports of LNG to our allies in Asia, Japan, and Korea. At the same time, we're asking them not to import Iranian crude oil. So there are benefits associated with this new world, and there are risks associated with it, but depending upon how things play out politically. You have another issue, I think, that's facing us is the demand sinks that are coming. The big refinery expansions, the petrochemical plants, the LNG export facilities, these take a very long time to develop. The first big, Chevron Phillips, has 2 plants that they have just gone to final investment decision on. They don't come on stream until 2015, 2016 or something like that. NGL prices are going to be pretty crummy here for the next few years until those step functions of demand show up to begin taking some of this excess supply. In the meantime, we'll try to export everything that we can. These battleships or aircraft carriers are very big and they're very slow, and it takes them a long time to turn. So you're going to have a lot of volatility in commodity prices as producers continue to produce and demand caps out in step functions. I'd be remiss if I didn't comment a bit on renewables. Haddington has had 3 or 4 different investments that we've made in the renewable space, in the green space. We're the leading developer of compressed air energy storage, a way of holding and storing bulk energy, primarily wind-generated power that's out of sync with demand. We have a biodiesel refining business where we use non-soy-based oils, non-food-based feedstocks to manufacture biodiesel. We have a water treatment business in the Marcellus that treats frac flowback water. It gets to the point where we're actually allowed to put the discharge in the Susquehanna River. We're the only company in the state of Pennsylvania that's allowed to do that at this point. So I think renewables have a role to play. I think they don't get to the point where they move maybe, actually in the presentation I said 20 to 25%. The more I've reflected on it, maybe it's 10, 15% as part of the, if you will, the generations stack in this country. There is money to be made there, but you have to be very careful about the way you deploy capital because the government sets up a series of rules and regulations to encourage certain activities, and then we get it to the excess, and then they decide, well, we're going to pull it back. And the way we're going through the wind tax credit, where it expires every year, it's very difficult to do any sort of long-term planning about those types of investments. In conclusion, I would tell you that if you look between now and, say, 2025, 2030, you're talking about demands for capital that approach, $500 billion in the midstream/downstream space. I think there's an important role for private equity to play in deploying this capital. Once the capital is deployed, these assets tend to be very long-lived. They generate very attractive rates of return and should be attractive to certain portions of your portfolio. And with that, I'll turn it over to Gary.
Yeah, great.
Or back to Jim.
Yeah, that's either or. That's fine, Chris. Thanks a lot. I think we'll finish up with Gary's comments, where Lime Rock takes a broader view and seeks very opportunistic opportunities across the energy spectrum. So it'd be great to get Gary's perspective. Thanks.
Thanks, Jim, and thanks Greenwich Roundtable and all you for coming. Just 2 seconds on what Lime Rock does, and I'm going to speak very broadly about the sector. We're not total broad. We're just in upstream oil and gas, oil field service, E&P, but do it globally. We're like Haddington, 15 years old this year. We have an office in London, Houston, and then the global capital of the world oil business, Westport, Connecticut. So you should feel privileged. You're so close to the center where the action is. What everyone around the room probably wants to know is how do you make money in oil and gas over the next 5 or 10 years? And it's the exact same question we ask ourselves, every single day. And before I kind of talk about sort of our current thoughts, it's probably pretty helpful to look back on the last 10 years. And it's actually a pretty interesting sort of math exercise. The 2002 to 2012 decade, you really had it split in two, and some pretty amazing things happened in the first half of the decade and the second half of that 2002 to 2012 decade. The first half is you had a complete revaluation of oil and gas prices, and this is wonderful. Oil was $20 a barrel in 2002, but before it collapsed in 2008. It kind of peaked $140 a barrel, and you saw similar things on the natural gas side. So a huge creation of wealth in the oil and gas business just based on that revaluation of the fundamental commodity we're producing. Just as that party was ending, you had a second party in the second half of the decade, which is a revaluation of land prices in the United States. Ben talked about $800 an acre, kind of starting from $25 and going to $800 an acre. But to give you a context, right now in the Eagle Ford Shale, people are probably paying $80,000 an acre, for more developed areas. But in the Barnett at the height, people are paying $25,000 an acre. So you're really trillions of dollars potentially of wealth created. You have 300,000 drilling locations right now, probably in the unconventionals, sort of the number that's thrown around. I don't know where it comes from, but everyone throws around that number. You're drilling 30,000, 40,000 wells have been drilled a year, and really trillions of dollars. So you had this decade, just these two tremendous things happened, and now you're in 2013, and unfortunately, those those things that happened in the past are now over. Oil is unlikely to be going up another from $100 a barrel to $500 a barrel. That's not really going to happen. Land, there are some plays that Ben talked about that are emerging, but for the most part, the conventional wisdom, and probably you like it, it's the conventional wisdom, is the kind of the land rush is over, and people know where the properties are. These are in areas that have been revived already in Ohio, North Dakota, Pennsylvania, stuff you read every day in the newspaper. So, on top of this, you have an outlook over the next 10 years where you don't really see these two big tailwinds you had, where you have a tremendous amount of capital has come into the market. And in every sector that I'm sure everyone hears about, the opportunity comes in front of the capital, and the capital lags the opportunity set. So just huge amounts of capital coming to a sector without the two things that have really created a lot of the wealth over that last decade. Ben was I've never met him before, but he was like a legendary sell-side research analyst. And then it was like a double disappointment when he decided to get into the private equity business because we can't read his research anymore. And it's just another firm trying to go after the sector. So when we think about going forward, we think about commodity prices. You've already seen on the natural gas side, sort of flat to declining over the next 5 to 10 years. And you really have to, how do you create value in the oil and gas space? It's through corporate growth, it's through asset level growth, and it's through more efficient, kind of operations of assets that are out there. So I'm going to talk about kind of the 4 areas we roughly look at and talk about sort of the opportunities and challenges in each. One is sort of North American kind of E&P development, probably a little later stage than the stuff that you heard about. Second, oil field service. Third, international, which we're very active in. And fourth is an opportunity in kind of more mature fields, producing fields that are a little bit kind of outside and a little bit more of a niche. So kind of, so just talk about the opportunities and challenges in each one. In North American E&P, the opportunities, this is some of the best returns, fundamental drilling returns in the world. If you have drilling locations in the Utica, in the Eagle Ford, in the Permian, in the Bakken, this is very rare for the history of the U.S. oil and gas business over the last 20 years. The fundamental break-evens are amazing, and if you have those locations, you will drill them in a lot of these places in almost any commodity price environment, and that's not able to be said. You're also in a very, very exciting time in the U.S. oil and gas sector. This is now a very technology-driven industry where all of sort of the laws of diminishing marginal utility are predicted every year, that the wells eventually are going to get worse. In fact, the wells are getting, still getting better. The idea of sort of the cloud analogy that was kind of talked about, we are just finding a way to kind of access more of that cloud every year with new technology. So it's if you have drilling locations, if you have an asset base, if you're able to get an asset base, it's great. The challenges are it's hard to get those asset bases. You have 3 big plays, two in Texas, the Permian and the Eagle Ford. You have the Bakken in North Dakota as the big oil plays, and you kind of have the Utica and parts of the Marcellus. What we've found over the last few years is in these plays, the 10-to-1 analogy, the core is getting better and sort of the fringes are getting worse. So you've had a little bit of a consolidation of the sector in terms of where the areas that people really want to do it, and there's obviously a lot of capital chasing that. The second is increasing efficiency. It's sort of capitalism 101. The oil and gas business is not immune from it. That increasing efficiency leads to declining commodity prices. We've seen that in the collapse of natural gas prices. Oil is a much more complicated, little bit of a complicated story. But as you've seen this in the Marcellus shale, for instance, as the core of that has gotten better, where 3 years ago, if you drilled a 5 billion cubic feet ultimate recoverable well, you thought that was amazing. Now, 18, 20 billion cubic feet ultimate recoverable reserve wells are getting pretty standard. It's rendering the rest of it, less economic. So, that's the challenge. And then the third challenge is for private companies, at least what we're doing, it's harder to exit these companies than it used to be. It used to be in the energy private equity business, you drill 30 wells and sell it to Chesapeake. Well, as everyone knows, Chesapeake isn't buying anything. Chesapeake's selling things now, and it's just a completely different sector. There are exits. The public markets are starting to open up. There are still, but it's much different than it was before. So, if it's very hard to do North American E&P, everyone in the oil and gas business loves to quote the Mark Twain quote, like if you. When everyone's looking for gold, it's good to be in the pick and shovel business. So a very common thing, you see it all in the headlines, is the Saudi America, let's go in the pick and shovel business, let's go into the oil field service. And there are opportunities there. There are, in a technology-driven, sort of very dynamic business, if you can create an oil field service company that will help the efficiency, that will help lower the costs, that will help meet some of the fundamental challenges like water treatment, that will help sort of geologically companies sort of kind of increase more exploration oriented offshore to kind of drill subsea completions and the like. There is a fundamentally a dynamic industry that's open for younger companies to grow market share. So it's something that we look at every day. The challenges there are, and this is particularly talking about North America, as much as you've seen U.S. oil production climbing 10, 14% a year, we've actually done that. Spending's been flat this year from last year. The rig count's flat. Down from last year. The well count's flat from last year. So what you're seeing is an industry where the operators are actually doing more with the exact same amount of spending, exact same amount of heavy assets. And there are sectors where you actually have too much of drilling rigs, pressure pumping, which is the equipment that actually does the fracking, huge oversupply in certain areas. And the oil field service also has, probably, at least in our sector, North American oil field service is far and away the most competitive sector we see, where, you'll have 20, 25 bidders for a company, very aggressive use of leverage from a lot of generalist private equity firms, and it's very, very difficult. So if this is too hard, forget America, let's go overseas, the international, and this is something, that's very, also, interesting to us. North America represents only 27% of global spending. Probably 10% of oil and gas production, And this one I'm actually going to flip it and sort of start with the challenges of doing international on either the oil field service or the E&P sector. First of all, U.S. entrepreneurs are better, in terms of fundamentally private equity, small, aggressive companies. You just have a longer history of entrepreneurship, and in a fragmented sector, they're better than here. Oil field services are better in the U.S. If you have in West Texas, you need a coil tubing unit. You can call 5 guys, and one will get there in 45 minutes, one will get there an hour, one will get there an hour and a half, and one will get there in 2 hours. And that's how you can compete. If you're in Tunisia, you need a coil tubing unit. You don't do it by the clock, you do it by the calendar. You'll hope Schlumberger will bring in their 6th-rate unit from some other country in a month and a half. The exit markets are better in the U.S. The public markets, selling up to private equity on the oil field service side. And the interesting thing that's always been in the service and the capital markets and the entrepreneurs always been better. Right now, what I said earlier, the rock quality is probably better in the U.S. Than at least what we've seen. You've had the only country that's even seen the glimmers of what you've seen in the United States is Argentina. And then Australia, you're starting to see sort of the pre-glimmers. And then China, there is you're starting some very long-standing projects. But it just what we talked about, the exciting thing about being in North American E&P, it's because just sort of the fundamental returns of drilling gas in Pennsylvania is just as attractive as any place in the world right now. So there are opportunities there. One of the good opportunities is everyone likes the U.S. better than it does like internationally, so the competition is significantly less internationally. The offshore market is huge globally, tends to be the province of very large companies. These are wells that cost $80, $100 million, but on sort of niche service and in the public markets, there's a huge offshore market, and the combination of that sometimes allows for some pricing inefficiencies that's hard to see in the United States. For instance, a deal talking about with Jim and Ryan earlier that we did is a company called Shelf Drilling. We bought Transocean's 38 of their jackup drilling rigs of kind of older vintage for what we thought was 3.5 times EBITDA. It's going to turn out to be 2 plus times EBITDA. Which is an incredible opportunity to do that. An inefficiency in pricing you wouldn't be able to see in assets in North America, just because there are less people, especially in private equity, looking at internationally. So finally, kind of shifting back to North America, all the activity is looking, drilling new plays, oil field service to service them. What about the assets that have existed in conventional plays? Is there an opportunity there? And we do see that. Our Lime Rock Resources Group exclusively focuses on buying mature, producing, primarily conventional properties that have sort of been left behind. This is a lower risk strategy, kind of very probably similar, probably a little bit higher risk profile than the stuff Haddington does, but kind of targeting the mid-teens returns, distribution. There's about 5 private equity groups that do it, about 10 publicly traded upstream MLPs. And the opportunities here, are, again, there are some exciting opportunities, where public companies seeking to rationalize their portfolio, they're all, a publicly traded E&P company 8 years ago, a lot of times just had assets everywhere, isolated legacy assets, and they are all becoming much more efficient and becoming really emphasizing core specialties, sometimes in one basin, sometimes in 2 basins. And there's just, when you've had a complete turnover of the entire U.S. oil and gas sector, a lot of people have assets they don't want anymore. So there's a very good deal flow. There's a deal flow from private companies that used to dream of selling after drilling 10 wells to Chesapeake, are now having to think about, let's sell the production and the cash flow. So there's a good rationalization of properties there. You're buying properties from, as we like to say, there's a lot of chicken left on the bone, where the asset owners, these were non-core properties, they didn't really take care of them, or that's an exploration-oriented group that that really wasn't good at kind of efficient operations. So it does feel like this is it's a very liquid market for properties. The challenge is sort of the repeated lament of, why doesn't everyone just give us the properties to do ourselves, and why does everyone have to compete against us? This is really annoying. But the challenge is it's a very efficient market in the United States, even for these kind of properties. It's kind of get 1 or 2 deals a year would be an exciting deal for us. And there are years we don't do a single deal on the Lime Rock Resources side, just given the competition. So I think the commonalities in all 4 of these sectors: the North American E&P, the oilfield service, the international, and mature producing properties. One is it's a kind of a fun time to be in the oil and gas sector right now. It's a dynamic industry. It's a technology-driven industry. There's a lot of change. There's a huge amount of efficiency gains. There's new basins being opened up, assets finding its way to the most natural owners. And the oil and gas industry was not always the most dynamic industry in the world, and was not, I think, probably when we started a career, not thought of always as the most exciting place to be put, if you're talking 20 years ago. And the other exciting thing is it's really feels like we have solved the main purpose of the oil and gas industry, which is to provide reasonably priced, stable supply of oil and gas to the world, which is ultimately what we're in business for. But the other commonality is, as fun as it is to be, it's now fun on the front page of newspapers and magazines, and there's a lot of capital chasing it, and a lot of capital chasing it in a period where it's going to be probably much more difficult to make money than it was over that 2002 to 2012 period, where you had just those 2 huge events that created a lot of the returns we're trying to repeat.
Yeah, thanks, Gary. Given the time we have left, we'd like to open up for any particular questions from the audience.
What do you think the odds are of a substantial drop in oil prices, 20% or more? How far do you think it might go down? The oil curve is sharply down over the next 5 years as it now. Is that an arbitrage opportunity, or is the market really right?
I assume you were asking me.
I mean, my personal view, I think I differ marginally with some of the comments were made, and this is why, which is I genuinely believe that if you go back and look at finding and development costs over the last 15 years for oil and gas, one of the interesting things is finding and development costs for gas haven't fallen. They've actually continued to escalate. They're around $2.70 for proven developed F&D today, which is one of the highest levels they've ever been. I genuinely disagree with the statement that unconventional resources are cheap or stable. I tell you, at $70 oil, the Permian would shut down. I mean, Gary's right, which is average well performance has gone up. And in the core of the play, average well performance is extremely good. But the thing that's hard for investors, and particularly the sell side, my biggest criticism, is that the sell side says, well, the Barnett sits here on the cost curve, or the Marcellus sits here on the cost curve. It's just utter rubbish. The best part of the Marcellus sits here, and the worst part sits up here. And what you've seen in the gas business is there's gas guys making great returns, Cabot, Range, who are in the core of the play and the best part of the play. And there's gas companies that are out of business who are in similar plays. I mean, I'm trying to think of the Haynesville player who went bankrupt, but there's a long list of them out there. The reality is the U.S. has historically been on the top end of the cost curve. There's good parts of the back and bad parts of the back, and there's a lot of these plays. And in my mind, if you saw a 20% drop in the commodity, you'd see a big drop in the activity set. I think, oil is a global market, so I think you have that going for you. Personally, I think GDP is strong. I don't think the supply impacts it. Saudi's still at peak levels of production despite the growth in the U.S., which is something people don't notice. I actually think the biggest risk for the U.S. is an infrastructure risk, which is the U.S. is going to be long crude, short refined product. And unless the U.S. changes the rules around crude oil export, you're going to bottleneck crude back into the U.S. market and still be importing refined product, which is ludicrous. So I personally don't think it's particularly high risk. I think the marginal cost of supply on average is still escalating. I think the key is to be at the front end of the cost curve, and the biggest issue is for the U.S. to allow crude exports, even if their swaps are a refined product.
I would agree with just about everything he said, except for one thing. We started our predecessor company in 1984, and that was back, early 80s. The boom was on, and crude was at 30, and it was going to 90, and gas was escalating dramatically in price. By 86, we had $10 crude oil and $1 gas because we just had too much stuff. We didn't know what to do with it. A lot of it turned out to be uneconomic. So the point that you raised is the thing that bugs in the back of my mind, bugs me is and what I was trying to allude to earlier is it's very difficult for demand to keep up with as much supply. He's right. We should be able to export crude oil and condensate from the United States, but currently don't. And there's laws that prohibit that. So I think you could see. I think the only thing I know for sure is you will have a lot of volatility in these prices. You know, it would not surprise me. I mean, we have a $15 Brent to WTI differential right now. That could go to 30 for, you know, a short period of time. It's not going to go straight up and to the right.
And, you know, my caveat in all of this is like asking someone in the oil and gas business about oil prices, like asking a fisherman about the weather. You know, we experience it every day, but we really have no idea. You know, are not particularly experts on what causes the sunny day or the rain. I mean, we operate on the strip, you know, kind of presuming that it's, you know, a relatively efficient market, and it's taking into account things that would lead to sort of a high $80 oil price, you know, in a relatively near term. I mean, that's sort of what, you know, we, you know, put into our models. And, you know, the two big scary facts are you have, you know, the big demand, you know, the incremental demand driver, China, you know, now decelerating both, you know, sort of economically, but also actually their oil efficiency, where it's kind of a 4% growing market from what you saw was you know, at times an 8 or 9% growing market. And the data out of China is always very complicated. And you have the U.S., which is a, you know, decline, you know, it's on a sort of a secular demand decline, growing at 10 to 12%. So if you have, you know, these two ends, which together represent 40% of the global oil and gas market, you know, you have, you know, demand coming down here and supply going up here. It's, you know, it can get pretty scary. You know, there's GDP, there's, you know, sort of, you know, Chinese demand predictions, and, you know, and the one thing that has really saved at least the global market for the last couple of years has been, you know, Iran coming offline, Libya coming offline for a while, huge disappointments in kind of the North Sea and Brazil, and, you know, presuming, you know, kind of continuing muddled along in all of those markets and demand where you see it, you know, our view is kind of it's pretty rational where the strip is right now. But, you know, I think we agree with Ben. You know, don't see it kind of collapsing below that, just given where the incremental cost is of stuff going on in the Bakken.
I think, again, going to the initial theme here, which is there are segments in this marketplace where you can add value with your cost of capital on a private basis that is differentiated from what we can all access in public markets. One of the things we've seen since 2008 is an interest on the part of investors in private equity to shorten the duration of their investment time frame. Can you give us some sense for the nature of the returns you provide to your investors in your strategies, or is this much like other private capital? You invest, you improve the asset, and at some point you sell. Is that the cash flow stream, or is it different in each of your strategies?
You know, we have two strategies. The Lime Rock Resources, which flag is a nice investor in both strategies. So we have Lime Rock Resources has a very different duration, where that is one where we are trying to buy assets and improving them for 2 to 3 years, but then you have quarterly distributions of cash flow. Those we're targeting kind of mid-teens returns. The Lime Rock Partners is much more kind of what you said, which is, you know, we underwrite to kind of a 3x return and a 30% IRR, but, you know, the duration, you know, 5 to 7 years, but it's a pretty fuzzy duration when we go into the deal, and it's you know, it's sort of, if you build it, they will come with sort of these small companies. And I think one thing that has changed, given sort of the, you know, publicly traded E&P companies on the E&P sector have traditionally been buyers of these assets. They are less, you know, needful of those assets than they have been historically, given the amount of organic drilling locations they already have. And so you don't probably have as robust of an exit market as you had just, you know, 3 or 4 years ago, or kind of traditionally, which means if you're backing a E&P company, you have to be willing to back it for a full duration with a public exit, which could be, you know, 7 or 8 years, or sell it to a production-oriented MLP or something like that. So it is, I think the hold period, unfortunately, given the dynamics of the industry, has gone the wrong way on the private equity side to a longer holds.
I agree. Our first two funds, I think our average hold was about 4.5 years. Fund 3, which is a 2005 vintage fund, is probably going to average about 7. Part of that was, 8 and 9 is the middle in there, and there was not a lot that was happening or going on. Capital to be raised, everybody was in the bunker. But surprisingly, I think the IRRs are going to hold up over that period of time because we didn't have a lot of leverage in the portfolio at times, so we were sort of just, we wrote it down and then it came back up. Our most recent fund seems like deal activity is picking up. Certainly, M&A activity has increased. People understand sort of the broader macro trends that are going on. Knock on wood, 4 might be go back to maybe a 4-year hold period, but we'll see.
Is there a current yield element to it?
Not in our portfolio, not with the development that we do.
I mean, from our standpoint, our strategy is really capital gains. I won't say we don't return anything to investors, but that's probably pre the final sale of the asset. If we're involved in buying land and drilling the initial wells, 100% of what we invest in the well and operating cash flow is reinvested in drilling more wells. It's the best capital we can use to recycle and enhance our returns. So we generally, our cash flow is lumpy, but our hold period varies. I mean, it's interesting when one of these plays takes off, it can be 12 months or it can be 2 to 3 years. While Illinois has been quick for us, it's actually been a lot slower, and the biggest delay has been Illinois legislation on horizontal drilling. If we'd been allowed to drill horizontal 12 months ago, or if Illinois had got its permitting act, because you are allowed to drill a horizontal, but you can't actually permit horizontal because they don't have the employees to do the permit for the horizontal, then we'd have drilled one 12 months ago, and it would have been a quicker process.
Thank you. Very helpful.
So we talked a lot about capital that's coming into the industry. Can you just give us a sense of how large is the capital that's coming into firms like yours versus what is the capital need to develop a lot of these resources?
You want me to go first? I haven't looked at the pre-Quinn infrastructure statistics. There is a lot of money that's come into infrastructure funds over the last several years. I don't have the numbers at my fingertip, but the infrastructure funds, my experience is they have tend to be sold more on long lived nature of the assets, toll roads, airport authorities, pipeline systems, etc., that have a tariff that's got some sort of indexation feature and 30, 40, 50-year life, and will give you single-digit returns. We have seen infrastructure funds come to us, Addington, and ask if they can provide us development capital in advance of us constructing the asset so that they have the opportunity to buy the asset when we place it in service. That tells me, at least in this 10 seconds in the marketplace, that perhaps there's too much capital chasing a strategy that doesn't currently exist right now. But broadly, infrastructure, new infrastructure development is, I think it's on the order of, $500 billion over the next 10, 15 years.
I mean, just to give you some high-level numbers, the U.S. industry, as Chris said, now is one of the biggest producers of oil and gas, around 16 million barrels of oil equivalent per day. To put that in figures, it translates to about 6 billion barrels of oil that are produced every year that need to be replaced. When you think about a $20 average F&D cost, right, you're talking about 110, $120 billion of capex every year in exploration and development. Around 10% of that goes on exploration, so 10 to 12 billion. If you look historically, that number's been pretty true. And to give you an idea, our funds, our average fund is about a $200 million fund. We have a hard cap at on this fund are 200, the next one will be 250. So we're relatively big relative to the total spend in exploration, but exploration is a relatively small niche compared to the total capital. But there's a lot of money that needs to be spent in the exploration, production, development, infrastructure business, and that's just U.S. Worldwide, you're talking 80 million barrels a day plus about 90 million barrels a day of production.
Yeah, we just did a back of the envelope, sort of 12 private equity groups, large ones, had raised about $35 billion in the last couple of years, and then you kind of stop losing count because so much of sort of generalist private equity is very aggressive in it. A banker told me that they have counted 200 generalist private equity firms have at least one oil field service deal in their portfolio. So, it's sort of an infinite number. The one thing in context is, Exxon's CapEx is $30-35 billion a year. So that, there's the amount of oil and gas private equity raised cannot talk about $1 trillion, that's the total upstream spending is $1 trillion a year. It's not going to kind of bend that, but there are very localized areas where oil field, middle market oil field service, for instance, in the United States, certain plays, kind of probably more advanced in the stuff Ben does, but not quite the mature ones. You could have 4 or 5 private equity backed companies chasing it, fighting, lease to lease, ranch to ranch. So it's though it's not going to be enough. It's not going to kind of completely, kind of define the industry, which I assume like venture capital defines kind of sort of the investment, given the scale of the public companies involved. It doesn't mean that there aren't, you go around and there aren't some stuff where it's probably overcapitalized for sure.
I think maybe one way to finish up the conversation is to think about that question. We've seen anecdotally that the typical oil and gas fund in the United States has increased its fund size by a factor of 2 to 3 times over the last 5 to 7 years, which, for the value add space is pretty incredible. A lot of that has caused those particular investors to move up market. So we're seeing an awful lot of interest in 2 areas: larger deals, which tend to be just more efficient by their very nature, or core deals. So, and I'll now expand as a final point beyond the area of oil and gas, whether it's timber, whether it's agriculture in the United States today or globally. We're seeing an awful lot of investor interest for cash flowing, very stable properties, whether it's a proxy for their fixed income portfolio or it's just pure inflation hedging. The real issue, if you're going to invest in private capital today and try to enhance your portfolio away from what you typically can get in the public markets, is to find really good skilled operators, which again is the whole purpose for investing in private capital to begin with. And I think that through this whole conversation, whether or not the land rush is over, I would suggest to you that I'm not going to answer for Ben, but that a $200 million fund size is far better positioned to go after those discrete opportunities than the $1 billion fund size, to the degree that could be raised. And I think that's probably that ends the lesson, which is there's an awful lot of macro opportunity. The problem is how do you access it? The answer is you access it through a skilled management team that has the appropriate time horizon and the appropriate orientation around risk. So with that, I'd like to thank our 3 panelists and give them a round of applause, please.
Thanks, Jim. That's a terrific discussion. I hope you learned a great deal. A couple of housekeeping items for the roundtable. We will not have a session in December, so enjoy your holiday off. Our annual meeting of the Greenwich Roundtable will be held on the Friday, December 13th at 9 a.m. In the Greenwich Roundtable offices at One River Road in Coscob. Invitations will be going out for that meeting shortly. Our next session, though, will be on Thursday, January 23rd. Title is "The Doctor is In. Has Biotech Investing Arrived?" We certainly hope so. Please arrive yourselves and have a very pleasant holiday. Again, thanks to Jim and all our panelists for a terrific discussion. And that concludes our session.